XOVR is the ERShares Private-Public Crossover ETF. It launched in its current form in August 2024, when ERShares converted an existing entrepreneurs fund into a hybrid that holds both public growth stocks and stakes in late-stage private companies. The pitch was simple. For the first time, a regular brokerage account could buy a piece of SpaceX and Anduril and names that were never going to trade on the New York Stock Exchange before an IPO. The fund grew fast. By the end of 2025, assets crossed $1.5 billion. SpaceX exposure climbed to roughly 11% of the portfolio. Anduril sat alongside it. Public holdings filled out the rest, inside a wrapper you could buy in seconds in a Robinhood or Fidelity account. Here is how it works under the hood. XOVR does not own SpaceX stock directly. It owns shares in a special purpose vehicle, an SPV, that holds the SpaceX position. The SPV is priced periodically, not daily. So when SpaceX is rumored to be worth $250 billion one quarter and $1 trillion the next, those moves do not flow into the ETF the way a public stock would. The manager decides when to mark the position up or down. Here is the catch, and this is what the marketing leaves out. Between December 2024 and February 2026, SpaceX's estimated valuation roughly quadrupled. XOVR's per-share SpaceX mark sat at $185 for most of that stretch. When the official markup finally came in early 2026, it barely registered in the fund's net asset value. Analysts pointed to SPV fees, dilutive terms, and structural friction. The result for investors was the same. They bought XOVR for SpaceX upside and watched SpaceX climb without their fund following. Why does this matter beyond one ETF? Because of what happened next. When investors realized the SpaceX exposure was not tracking the way they expected, money started leaving. Over $627 million walked out. And here is the structural problem. When cash leaves an ETF, the public stocks get sold first because they are easy to sell. The illiquid SpaceX SPV stays. So as a percentage of a shrinking fund, SpaceX ballooned to roughly 45% of total assets. That is triple the 15% cap the SEC places on illiquid holdings in open-end funds. Performance has reflected the strain. As of February 2026, XOVR had lost roughly 4.5% per year since the SpaceX SPV stake began. Over a 5-year window, it trails the NASDAQ 100 by about 70 percentage points. The expense ratio sits at 0.75%, modest by private asset standards, but well above a plain index fund. So who is this fund for? It is for investors who want a public market wrapper around a pre-IPO position, and who understand that the wrapper changes the math. The SpaceX IPO, rumored for June 2026 at a $1.5 trillion valuation, could finally close the gap between what investors paid for and what they own. Or it could not. That is the bet. The honest takeaway is this. If you want SpaceX, XOVR gives you indirect daily liquid access in a wrapper that has not yet delivered the upside the underlying asset has produced. Eyes open. If this breakdown was useful, hit like and subscribe. And drop a comment. Would you hold XOVR through the SpaceX IPO or watch from the sidelines? I read every reply.